what is a direct index? So that's probably the first question. It's an index where you start with the index itself, or some sort of index, and then you actually customize it to what you want. And so it was exactly what an example of what we do for people in it is you can either use our own, you can either do it to our own actively managed portfolios, or let's just say you wanted a passive portfolio, and you're an Australian investor, and you're like, well, I want to invest in Australia, but I actually don't want to be 50% banks and resources. I'd like an Australian portfolio that's a bit more, that's weighted a bit more like a normal one. And so you can come in and cut stocks out or cut sectors out and say, okay, I'll take the Australian index X banks and resources, and I'll buy those separately. Or you can do all the ethical screens over the top, and you can say, okay, well, actually, give me the global index, but I don't want anything to do with carbon in that. Cut out any of the carbon stocks, or cut out anything to do with nuclear or war or whatever your own personal feelings are on those ones. And also, so that's one part of it. You can also then add in some tax strategies in terms of actually being able to sell some of the losers and actually harvest some of the tax losses, or investors in the US can do that. Australia is a little bit more limited in terms of what you can do, but there are tax strategies that are available in Australia as well. And we're looking at adding in some ones now to our portfolios, and you do have them in a lot of the overseas ones where you can start adding sectors as well. So saying, okay, well, I'll take a global market, X tobacco, X carbon, and I want some extra technology stocks in there. And so that type of thing is possible. And especially if what you might find is people who already own their own business in a particular area. Let's say you've got a business and you're a property, you're in the property market. You might decide that if you own your own property, you're in a business that's in property as well. You don't need property in your investments. You've already got enough in that in your personal life or other investments. So on your share market, you just cut all of the property sector completely out of your portfolio, and maybe banks or something like that as well. So direct indexing, it really does give this customization part where you can still rely on sort of professionally managed portfolios, but without having to do everything. And so it's a part about saying, well, you could do this by building up this with a stockbroker or setting it all up yourself. But the issue then is you've got to then manage that portfolio and make sure that when stocks drop in and drop out and corporate actions happen and all this other stuff goes on, that you're actually still in the portfolio you thought you had. Whereas with a direct index, you're saying, I want the 25 or the 40 largest stocks in this market. You manage that for me, but just make sure you don't buy any any carbon stocks or whatever it is you decided to cut from that portfolio.
Yeah, and Damien, just one other distinction I just want to add is with a traditional exchange traded fund or index, you just buy one security and the manager's buying all the underlying securities, whereas the direct indexing, you actually own all those stocks individually. And that's what really gives it that ability to customize it and add things and align it to your ethical values and beliefs, or have those sector or asset class tilts.
And the tax benefits as well of that, because what you tend to find is, and this is a very big one in the US because the tax laws are a lot easier about it. But you can still do this within Australia to a certain extent, but it's not as easy as in the US. But in the US, why they've exploded so much is because you can say, I want to harvest all the tax losses. So buy me the top 70 or 80 stocks, and then sell the 10 that have the biggest tax losses every year, and then buy them back, 6 months later, or put them put those into similar securities, and then put me back into that index fund in a few years' time. So you can have these strategies that actually get you that sort of harvest those capital gains for you every year, and sort of get you that in the US you can. For some of your earnings, you can use it like negative gearing. You can sort of write it off against your actual income. But within Australia, there's obviously benefits as well, just in terms of being able to say, well, I've got capital losses that you sort of you've got there to offset your capital gains at a later stage. So I've got a table up just sort of showing the most common ones. So there's 4 different ways people use it. One is for these tax focused strategies, which does generate greater returns for your portfolios on an after-tax basis. If you're in the right, depending upon what portfolios, obviously if you're in pension mode in Australia, then you're not getting any tax anyway, so that doesn't sort of benefit you. But for other more high tax paying ones, the personalization, so you get all these, the social governance and the ethical screens you can do, and other types of factors. You get all the rules-based strategies. So, if you want some extra quality in the portfolio, or you want some extra value stocks in the portfolio, you can sort of, under different ones, you can add these sort of rules-based strategies in, so you get those in the quality, in the quantity that you like, and then the whole customization part about this, we see people who have got, say, they're a banking executive, and they're investing in that, and they're not allowed to invest in their own stock, and they already get stock as well as part of the options plans, and they don't want to invest in competitors because they're banking exec with lots of exposure to that sector already. Is they go, okay, well, give me the index, but cut out all the banks, so that they can they can see that the portfolios have been truly customized to their own investment needs and thought about as part of the greater pie, versus just saying, hey, I'll take an ETF that's just got all these things in it anyway.
Yeah, and that's a good point with what we do, Damien, is you have the ability to exclude Australian banks. So if you're bearish on the Australian housing market, for example, or you just don't want that over concentration in financials that the Australian market offers, you've got the
or you already own the banks
really
in your own name, and you've got, there's a lot of people we see who get, they've been they've got shares as either they bought it 20 years ago, or they've got an inheritance or something like that, and they've got those shares already sitting there, and they're like, well, I've already got lots of banks, and I don't want to sell those ones because there's these huge capital gains baked in for years. So let's not double up on everything. So some of the other benefits you can get from them, you can actually do fractional shares for some of the US and European now. So we're sort of rolling that out, and it's quite common in the US, but yeah, we're rolling that out now over the next few months for Aussie investors. You've got that thing about how much personalization you want. You can go active, you can go passive, take your pick on that. Fees is obviously important. The fees we're sort of looking at on some of our newer products, depending upon how much you put in there, can be sort of as low as sort of 20 basis points type thing for if you're putting lots of money into it, but sort of start at sort of 38 basis points for passive. So the types of fees you pay are pretty commensurate with I guess what you pay on a lot of specialty ETFs. So not the if you're just buying the S&P 500, for example, you can get that for sort of, I don't know, 3 or 4 basis points probably. But if you want some of the tax efficiency and customization, then sort of paying sort of 20 or 30 basis points for it is pretty it's commensurate with, say, buying an Australian ETF, which would be priced around that same amount, or buying, say, some of the global ones, might cost you more, like a European ETF is in that range anyway. So so the fees are pretty cheap on these, mainly because it's all technology driven nowadays. So it's much they're certainly much more accessible. But I guess where I'm getting to with indexes is the overall part of indexes. There's some interesting parts to it. For me, the ability to customize it is the more interesting part for investors, and that's what you should be thinking about as direct indexing solutions that are out there. Is looking at these and trying to work out how can you use these direct indexes to not only get the benefit of having these indexes and low fees, but actually incorporate it into the other things you're doing and actually have something that sort of fits your own investment profile better.